Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, December 8th, and I'm recording this from our studio in Purchase, New York. As we enter the fourth year of the equity bull market, investors remain obsessed with the pace of Federal Reserve easing. Last month, brief doubts about a rate cut in December took the S&P 500 down as much as 5%. And when the probability of a cut rose back to 90%, the market has completely recovered. Rates matter, of course, but perhaps not in the way that they used to. In fact, several changes since the great financial crisis have structurally reduced the Fed's ability to actually stimulate the economy and manage inflation risk through the Fed funds alone. For example, households and businesses have materially deleveraged, and the household debt that predominates today is less sensitive to actual Fed rate cuts, including credit cards and mortgages. The power of the Fed moves has also been limited by the shift from cyclical goods manufacturing towards a services-based economy, major wealth and income inequality, and the extraordinary growth in shadow banking, which includes private equity and private credit. This structural development is set to converge next year with the end of the Fed's easing cycle as it reaches the 3% neutral rate. In addition, we see the appointment of a new Fed chair who's expected to be ideologically aligned with the administration's objectives. These include managing the government's huge debt, with interest payments close to 20% of revenues, and growing our way out of it. We think that this confluence suggests a new policy regime is coming, one that is more tied to what we call fiscal dominance, with independent Fed policy giving way to managing the constraints of U.S. debts and deficits. Under this new regime, the central bank's emphasis will likely shift to its balance sheet, duration management, and policy framework adjustments. So, what are the implications of fiscal dominance? We expect at least three related developments that we could see next year in 2026. First, the Fed should begin to grow its balance sheet by mid-2026, absorbing as much as $250 billion of annual Treasury issuance in a stealth form of quantitative easing, or QE. We also expect the Fed to reinvest the paydowns from mortgage-backed securities into Treasury bills, matching the Treasury's preference for issuance. This should allow the Treasury to keep the size of coupon auctions stable, anchoring the belly of the Treasury yield curve. Finally, the new Fed chair will likely lean dovish and implement a run-it-hot strategy by resetting the policy framework. We think this could even include shifting the inflation target from today's 2% to tomorrow's 3%. Under a run-it-hot approach, economic growth could surprise to the upside in 2026, but with inflation risks rising. And earnings growth may be higher too, though valuation multiples could be pressured lower, keeping U.S. equity gains closer to 10%. We also expect the 10-year Treasury yield to anchor above 4%, with higher term premiums, a steeper yield curve, and a weaker U.S. dollar. By year-end, we see positive correlations between stocks and bonds. Consider, therefore, rebalancing for maximum strategic asset allocation diversification and avoid single stock concentration. We specifically suggest taking profits in high beta, unprofitable, small and microcap, as well as speculative names where gains could be vulnerable in 2026, and we would redeploy to large cap core and quality stocks. These actually would include the Mag 7 and Gen AI productivity beneficiaries in sectors like financials, healthcare, and energy. In fixed income, focus your portfolio on quality and benchmark range duration. International equities and real assets, including gold, real estate, select private infrastructure, are also opportunities to add. As always, thanks for listening. And for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.